YouTube, podcasts, and every other alternative media outlet have been incessantly talking about an AI bubble. When will it pop? Who will be hurt the most by it? What companies are destined to fail? How AI concentrated private and public markets are, or if the bubble exists at all. Elon Musk claims there's a $26 trillion total addressable market for AI. Nvidia trades with a nearly $5 trillion market cap. Data center developers raise billions in private capital before moving a single shovel of dirt. Anthropic and OpenAI announce IPO plans with trillion-dollar valuations while losing billions. And investors can't seem to get enough of it. SpaceX blew past its $1.75 trillion valuation target in the first minute of trading. OpenAI raised $83 billion in private capital in the same year it generated a net loss of $21 billion, and Nvidia continues to produce chips at a record-setting pace. It's easy to understand how people look at all of this and rationally assume this can't continue, that we were headed for a Thelma and Louise ending, except this time it's Jensen Huang and Sam Altman holding hands as they drive off a canyon cliff. We know that corporate adoption of enterprise AI models has been underwhelming, that the most advanced LLMs are being viewed as potential national security risks, monster IPOs that cause massive rotation of equities from big tech to AI bets. Almost all public securities tied to any facet of AI are already sitting at unbelievable price to earning ratios. But none of those are the real canary in the coal mine. There's a far more basic and fundamental shift happening that will determine if this bubble gets bigger or bursts completely. First, let me clean up the Canary reference for anyone under the age of 40 that might be watching this. Coal miners used to keep canaries in a cage in coal mines as a primitive form of safety equipment. If the canary stayed alive, everything was fine. If the canary died, there was a toxic gas leak and all the miners needed to evacuate. Fun fact, some mining operations used canaries for this very purpose until the mid-1980s. Now, a canary in a coal mine is a metaphor for early signals something is wrong, off, or dangerous. And like I mentioned in the opening, the market has been looking at the wrong canaries or the wrong coal mines. I'm probably starting to mix metaphors here, so I'll move on. When SpaceX submitted their S1, AI was mentioned over 1,000 times. And as Ed Elson pointed out, that's more than the number of times Jesus' name appears in the Bible. SpaceX also claimed the total addressable market for AI was more than $26 trillion, or roughly the equivalent of the entire US GDP. Investors and commentators trying to justify SpaceX's IPO valuation pointed to the role AI products and services would play in the company's future, despite its low-orbit internet satellite service Starlink being the only profitable business unit at the company, and despite XAI being a company that, quote, needed to be rebuilt from the ground up, according to Elon himself. Chip makers SK Hynix, Micron, and Samsung have a combined $4.1 trillion market cap, which is the equivalent of the entire Japanese economy. These valuations are largely built on the thesis that data center demand and future buildouts will expand, each new data center requiring thousands of GPUs and TPUs. Chip makers are priced as if today's record AI quarters repeat forever, which is a fancy way of saying this is more vibe trading than any fundamentally sound investment strategy. Even with those positive vibes, one Goldman Sachs prime brokerage note showed U.S. hedge funds were net sellers of tech hardware and semiconductor stocks for a fourth consecutive week into early July 2026, making information technology the most net sold sector. All of this is more than enough ammunition for the hordes of people banging out anti-AI screeds, warning of the pending humanitarian and technological apocalypse. But this is all, in my opinion, irrelevant. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. To repurpose and essentially vandalize James Carville's famous quote, "It's the chips, dummy," and more specifically, the demand for chips and the compute they provide. And therein lies the true canary in the coal mine. On May 6, 2026, Anthropic announced a deal to take over the full capacity of SpaceX's Colossus 1 data center. That data center provides as much as 300 megawatts of power and more than 220,000 Nvidia GPUs. At the beginning of June, CNBC and others reported that Google agreed to pay SpaceX $920 million per month for XAI compute capacity. new capacity that would presumably be built out over time. Now, why would SpaceX sell their compute? I thought they had massive AI ambitions themselves. Maybe not. xAI merged with SpaceX to allegedly create more AI capabilities for SpaceX just a few months prior to its public offering. Shortly after that merger, Elon Musk admitted xAI needed to be rebuilt from the ground up. The SpaceX S1 specifically touted all the AI opportunities the company would exploit. Then, just days before the IPO, SpaceX announced their deal to sell their entire Colossus compute to Anthropic. Similarly, on June 1st, Meta announced Meta Compute, a cloud business to sell its AI models and raw GPU capacity to outsiders. This comes after they committed $72.2 billion of AI-related capex in 2025 and planned for up to $140 billion more. So much infrastructure that Zuckerberg now talks about monetizing excess compute instead of just using it internally. And the market loved it. The stock jumped about 9% after the announcement. There's another inconvenient implication here. These Colossus superclusters weren't built for Anthropic, they were built for Grok, Elon Musk's own model. But Grok's user growth and paid adoption have stalled, and enterprise interest is tiny compared to Claude or Gemini. So SpaceX is now renting Grok's training environment to one of its biggest competitors because Grok isn't using it. If demand for Grok were truly explosive, there wouldn't be spare capacity to sell. This is a clear and painful example how much AI infrastructure overbuilding can outrun real product demand. The same could be said about Meta. Stalled or failed AI products have led them to try and liquidate compute they simply can't use themselves. To put this in perspective, Meta and xAI were the 5th and 7th largest buyers of compute, either through their own build-outs or through cloud computing deals. They are now sellers of that compute. Together, those companies represent approximately $250 billion in demand that's now evaporated, and flipping 2 of the 10 largest compute buyers to suppliers. Now, you could argue the demand just shifted from Meta and xAI to Anthropic and Google, that the total demand didn't change. But there are a couple things to consider. First, Meta hasn't announced contracts or buyers of their compute, just a commitment to form a business unit to sell extra capacity. Second, the Google deal doesn't fully ramp up until October, and Google or xAI can cancel the deal within 90 days' notice after December 31st of this year. Third, and most importantly, Meta and xAI's spend created excess capacity. It was not purchased to meet current demand, so now instead of Google and Anthropic having to buy new, additional compute from cloud providers that would need to purchase additional chips to create that capacity, they simply buy existing compute from Meta and xAI. So, demand is satisfied with current inventory. No new chips need to be manufactured to meet that demand. The demand for compute and, more specifically, chips that we saw in 2024 and 2025 was driven by exactly this kind of capacity overbuilding, fueled by a belief someone would need this in the future. And now Meta and xAI are having a yard sale to sell compute that was just sitting in the corner getting dusty, like an old set of golf clubs. This creates a valuation problem for chip manufacturers whose stock price and shareholders are counting on demand continuing or expanding. Now, 2 of the biggest buyers of compute just dropped out of the market. But Meta and xAI dropping out of the buying market may be the least of the chip manufacturers' problems. According to the Ledger's Signal, an infrastructure investigation in February of this year found that 26 U.S. AI data center projects had been canceled through January of 2026. An April 5th, 2026 report summarizing Sightline climate data says nearly half of all U.S. data centers planned for 2026 are delayed or canceled. Out of about 140 planned projects targeting 16 gigawatts of capacity, now only about 5 gigawatts were actually under construction at the time of the report. The rest were pushed out or on hold. 11 gigawatts of demand, now unneeded because these data centers were canceled or postponed, would have required millions of new chips and generated purchase orders worth hundreds of billions of dollars. In February of 2025, Microsoft decided to step away from OpenAI's proposed $500 billion Stargate AI super data center project. Microsoft has canceled more than 1 gigawatt of data center leases across the US or allowed them to expire, including multiple individual deals of roughly 100 megawatts each. Analysts believe Microsoft likely overestimated AI infrastructure demand is now trimming back to avoid oversupply. There's even reason to believe the supply side of certain chip types were intentionally manipulated. Remember those chip makers I mentioned that had $4.1 trillion in total market capitalization? In late June 2026, those same companies, Micron, Samsung, and SK Hynix, were hit with a U.S. class action lawsuit alleging they coordinated DRAM production cuts and capacity decisions between 2021 and 2024 to inflate prices. The suit says the three firms control about 90% of global DRAM supply and claims DRAM prices rose by up to 700% over those 4 years. So why would a company do this if demand was actually outpacing supply? Short answer, they wouldn't. And market experts are also noticing this weakening demand. On July 2nd, 2026, the Philadelphia Stock Exchange Semiconductor Index, otherwise known as the SOX, fell about 6.3% in a single day. On top of the SOX losing more than 6% in a day, names like Micron and Intel were down 10.6% and 9% in a single session. JP Morgan is already telling clients chip outperformance is, quote, unsustainable. To recap, we have companies walking away from their own AI projects, other companies selling unneeded capacity, and a market that is slowly recognizing that infinite demand for compute isn't really a thing. All of which leaves us with our little yellow winged friend, and this canary is getting a little woozy. You've got Elon Musk pitching a $26 trillion AI market, basically an entire US economy's worth of upside, while his own AI company can't use the compute cluster it was built for. You've got trillion-dollar memory stocks priced as if every quarter will be record-setting. And you've got data center developers raising hundreds of billions of dollars for AI campuses that, increasingly, will never get built. That's why Meta and SpaceX flipping from two of the biggest AI compute buyers to sellers of excess capacity matters so much. Their spending is what helped create the perceived chip shortage and this extraordinary AI capex era in the first place. Now they're tacitly admitting they bought too much, and that's a systemic change in demand. If Anthropic and Google can satisfy their growth by renting that surplus instead of forcing fresh GPU orders and new data center builds, the marginal buyer that was supposed to keep chip makers' order books full for years just disappeared. And when the companies selling into this hallucination end up in court accused of coordinating supply cuts to keep prices high because organic scarcity wasn't enough, that's another signal. If demand were truly bottomless, you wouldn't need to engineer a 700% price increase and hope nobody notices. So if you're trying to figure out whether the AI bubble is real and if or when it might burst, don't start with OpenAI's next funding round or whatever valuation SpaceX manufactures next quarter. Those are lagging indicators. Go upstream. Which companies are selling compute instead of buying more? How many AI data center projects actually break ground and get energized versus how many remain blueprints? Whether chip makers can keep raising prices and shipping record quarters, or whether customers start stretching refresh cycles, renegotiating contracts, and quietly canceling orders. Make no mistake, the AI story can stay loud and bullish for a very long time. IPOs can still rip, private markets can still line up to provide billions in new capital. But once surplus capacity starts clearing the market and physical buildouts stall, when the hype that justified $5 trillion chip valuations and $26 trillion market claims fizzles, you're left with a simple reminder: the law of supply and demand remains undefeated. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.